Good morning, everyone. My name is HP Singh. We've uploaded our investor presentation. I'll just take you through the key highlights, what has been shown in the presentation. But the key highlights have been that it's been a very good quarter for us. We've maintained our history of profitability since inception. On a standalone basis, we've had a marginal PAT of about 4 crores in spite of the fact that we were probably the underdogs in terms of demonetization across which happened for the last 1.5 years or so. There's been a 104% increase in PAT for the quarter. For this, we've practically opened about 191 branches across the whole year in terms of our looking forward towards the AUM growth. And this has primarily been because of our lower operating costs. There's been an increase in disbursement, and it's been a stable portfolio quality after demonetization hit us. To take you forward through that, I think our peak gross NPAs was close to about 14.5% or so, and now the gross NPAs are close to about 4.4%. And similarly, our net NPAs, I think we're also close to a double-digit mark somewhere, and now they're down to about 2.6%. And in absolute terms, I think our net NPA now stand at about 130 crores, which also has been factored in terms when we've given our guidance for our ROA for the next year as such. So technically for us, this net NPA has been factored in, and that's what I repeat in terms of when we calculate our guidance for our ROA for the next year. Our technology has been fully operational at all our branches. And I think just to give you a cue, probably our technology is one of the state of the art, which gives live feed across every 2 minutes. I think it's probably one of the best in the sector as such. That we get a live feed collection from any part of our branch in any part of the country after every 2 minutes. We're also bringing a business correspondent entity also on the same platform, and I think we'll be live and operational by the end of next month. So that's also going to be up and running in terms of Parashna subsidiary also. In terms of our technology, also taking a cue from the cashless disbursements, which we started doing practically mid of last year. In terms of our branches, 51% of our branches are now doing cashless disbursement. And in terms of volume, the cashless disbursement is close to about 35%. But as we speak right now, that volume has increased to close to about 50 to 55% now in terms of the volume and amount. We've raised close to about 440 crores in multiple rounds during the last year. And that is probably one of the reasons why we maintain a strong capital adequacy now of about close to about 23.7%. Even in spite of the fact that we achieved a 40% growth in our AUM. Our AUM now consolidated basis stands at about 5,757 crores put together. And that is where the key highlights are. And based on our other products which we are doing in our other verticals, the SME is now close to an AUM of about 75 crores. Housing finance, which started in March in itself to start disbursing, they've done business worth about 3 crores in the first month in itself. We are targeting close to about 125 crore plus business in the housing finance space and close to about 150 crores business in our SME space. And we've given our guidance for FY19 to achieve an AUM growth of 40% plus and an ROA of 2.3% plus. And we are very, very confident of achieving the same. And I will hand over now to Jugal for a small piece of the exposure district-wide, which I think he'll let you go through that.
Sure. Thank you, sir. Good morning, everyone. This is Qtr4. One of the concerns that we have been hearing from all the stakeholders is on, geographical concentration in UP over a period of time, and our teams have worked very consciously to bring that down. UP concentration in general has come down from about 43% in financial year 15 to less than 30% now. We're at 29.7%. We have reduced our concentration in MP also from roughly 18.5% in financial year 15 to about 10.2% now. We expanded our business in in the eastern India, where we started West Bengal, Assam and Odisha, 3 states there, which are taking good shape. So it's a well diversified portfolio besides the north and central part of the country. We are now present in East India as well. So we have given on page 24 of our presentation. The average exposure per districts have come down from 0.85% to 0.35% during the last 3 years. And then within that also granularly, though we have about 29.7% exposure in one state, but the district-wise it is a well diversified portfolio. We have only 1% of the districts where we have more than 2% exposure, and in 92% of the districts we have less than 1% exposure. We have further given detail of the large 3 districts. Earlier, all the 3 large districts used to be in UP. But now, among the top 3, 2 districts are from Bihar, which is in Eastern India, where the repayment is not a problem. So in general, it's a well-diversified portfolio. We feel that this will help us, further reduce the risk in the business and have a very well-diversified portfolio. So with that, we sort of open the call for any Q&A.
Sure. Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. The first question is from the line of Kashyap Zaveri from Emkay Global. Please go ahead.
Yeah. Hi. Am I audible?
Yeah, please.
Yeah. Congratulations, sir, on really great set of numbers, and congratulations on reducing your NPL number to almost about 2.6% on net basis. I have a question on what Mr. Qtr4 was highlighting in terms of geographical distribution. Now, if I look at some of the states like Assam, Uttarakhand, and West Bengal, there has been a significant growth in Qtr4 as well as full year FY18. And in some of the states, if they suppose that with slide number 26, which shows Satin's market share in some of those, geographies, like for example, Assam, we are almost like a third of the, market share over there. Uttarakhand is almost about 39. So in a sense, yes, we are reducing our dependence on, some of the earlier larger states, which is like UP and Bihar, or, even including MP. But in some of the smaller states, our concentration is again getting too high as a percentage of total MFI exposure. So if you could, help us understand your, strategy in some of these states, what makes them so attractive, and, what makes you comfortable with aggressive growth in, some of these states like West Bengal, Assam, Uttarakhand, Rajasthan, if you could highlight your strategy over there.
I think I'll take out Uttarakhand out of the piece, first, but if you look at the eastern states, the penetration level-wise and the number of MFIs which are working over there in northern eastern states are lesser than what you would probably see in the southern part of India or maybe the central part of India. So that's one of the key strategies for us to look at these areas like Assam and West Bengal to a large extent. Uttarakhand, I think, for us, it's been quite a static, if you look at the whole state as such. I think, it's been a static geography for us, if you really look at it. I think, our focus is also to move away primarily from the northern states where we have been having a very dominant position across over there. And even having said that, I think bringing Uttar Pradesh down over there, we had to take a cue from the other states across over here. Uttarakhand, I think, is insignificant in terms of, I think it will remain probably static, or it will go down in the next year as such, The states which are going to probably come up is going to be, again, the eastern states to a large extent, with Orissa also playing a major part where we still have a low-base portfolio. We're adding on a couple of more states in Northeast. I think Tripura is getting added on, Meghalaya is getting added on, and where we feel that there is still a large room to grow. And even in West Bengal, if you really look at it, the number of MFIs per se working as compared to maybe the number of MFIs working in Orissa, Bihar and all, there's still lower numbers across over there. So that's one of the reasons why we are taking a key exposure in these states.
And does the political landscape in some of these states, doesn't it work as a deterrent to us?
Boss, if you weathered Uttar Pradesh, you can weather anything across anywhere in any state, yeah.
Sure. And second question is on your reduction in NPL. Now, if I look at the previous quarter, that is Q3, we reduced our gross NPL by about 61 crores to 395 crores and net NPL by about 75 crores to about 150 odd crores. If I look at this quarter, our gross NPLs are down about 170 crores, but net NPLs are down only about 18 crores. So it looks like, there has been significant recovery from the return of accounts in this quarter.
There won't be. So I think, what we are now coming at is probably the tail end of the demonetization space. So the buckets now which will probably be there will be the most hardest to crack on, So our own sense is, and that's the reason why I said in my opening remarks that we are factoring in the unprovided for amount also in our current year as such as a going concern. It gets a little challenging once these hard buckets come up, but we're still working on it. I think, we're trying a level hard, last 1.5 years we've been able to bring it down to these levels. But our own sense is, I think, we're still working hard on it. We are having different strategies to work on it, we're still trying to put that together. And let's see how much can we recover out of this, the unprovided part as such, These are harder buckets now, I think, we'll have to probably now look at it maybe in a different landscape altogether.
So this 170 crores reduction would be largely the provided accounts which have been now written off.
It'll be the
written off. Reduction in net NPA number. Okay. Yeah, that's it from my side. Thank you very much.
Thank you.
Thank you. The next question is from the line of Asimi S. from GCJ Financials. Please go ahead.
Hello, sir. Congratulations for good numbers.
Thank you so much.
Yeah. Sir, I would like to have the guidance on return on equity. You said we will reach 2.3 ROA. Also, can you give us return on equity guidance?
I think based on this, the ROA of 2.3% plus our return on equity would be close to about 15% or so. I think, that's what my initial estimate is. I think it will be closer to that.
Okay. And second question pertains to asset quality. Still our new loans with disbursed post Jan 1, 2017, we have collection ratio of 98%.
That's right.
So why is that not improving? Because our competitors are having more than 99%. So, and do we foresee any more provision during 2019 because of 2% not getting paid back?
So I think, let me make you understand, again, the genesis of from where we are and where our competitors are. I think, I've probably told this across this thing, and I think, that has to probably will have to sink in when people look at 98 of us and maybe our 99 of somebody else, Our portfolio and our geography was about 75% which was impacted, as compared to maybe our 25% of the other competitors of ours, Now, technically, we have to operate in the same geography where we have been working because our major portfolio was lying over there. So for us, having even come up to 98% collection in those 75% of your impacted territory as compared to a 99% of where people have a 20 or 25% impacted done. I think, for us, we probably have taken I think, that's something which is, I don't want to say it for myself, but that's something commendable which we've done, being able to do it across this thing. Our PAR at one point of time was standing at about 50% plus. Now, having brought that down to these levels, I think, that's the reason why 98% as compared to a 99% is probably far more comparable if you really look at that, But also what I would like to say that even in those impacted territories and all the territories where we've given our cycle 1 disbursement to the customers, there we have a 99.7% collection efficiency, which means it's not gone to the old impacted guys or anyone who had a PAR or anyone who has been there in our previous cycles. So any new client which we have acquired in even these impacted territories, our collection efficiency stands at about 99.7%. Though it's a small portion in the total portfolio, I think if you really look at it, it stands at about 33% of our clients in the total portfolio. So I think that's where probably the difference would lie. And we factored in whatever the unprovided portion is in our guidance for our next year, basically. So that's been, if you really ask me, that's been fully provided for.
Okay, so you don't see any big rise in the provision cost in 2019?
I don't think so. Anything major now coming up.
So what credit cost are we factoring in our budgeting number?
The unprovided portion of 130 crores.
130 crores?
Yes.
Okay. Thank you so much and all the best.
Yeah, thank you so much.
Thank you. The next question is from the line of Manish Sisodia from Nirmal Bang. Please go ahead.
Yes, sir. My question on the operating expenses growth, if I look at the operating expenses growth for the full year, is muted given the branch expansion. And so where we are saving significantly in terms of operating expenses. And secondly, how do you see the OPEX growth for 18-19 given the expansion plan?
So I think, it's majorly been the technology, cashless disbursement, everything which has added on to our reduction in our OPEX. Majorly that's been there. I think, smaller Q has been that we've been able to bring in far more efficiency in terms of our processes and our systems. Because earlier, if I just give you an example, I think, maybe technology helped us by cashless disbursement. Of bringing down, earlier it was a 14-day tag, credit bureau, being done maybe after about 10 days. So all that logistic, amount getting wasted down across over there. So it's been there. Also, I think the major factor which has probably brought down, and I have, clear-cut numbers across over there, which is probably been there in this thing. We've been able to bring down our service cost and our printing and stationery costs because of, cashless disbursement and the technology taking over, So that's been a huge reduction in terms of other things. Earlier, guys used to, ferry, simple example, ferry cash from, bank branches to our branches, then disbursement across over there. That's completely, going down, 55% of our branches are now turned into cashless, which we think will be closer to about 100% by the end of this year. I think that's where we have a significant reduction in our operating costs.
And in terms of operating expenses growth, sir, for this year?
This year we are projecting close to about, I think, from 6.28, we have a slight uptake of 6.47 or so, So with the expansion of new branches and everything, that's what we are trying to factor in across over there. But it's just a minimal 0.25 this point, moving up in the operating cost, but it remains static and stable at the same amount, same percentage.
Second question on the customer acquisition or new customer base is concerned, sir. If I look at our slide where it is mentioned that this year active customer in microfinance side is 2.4 million customer versus 2.3 million customers. So in terms of customer acquisition rate is very muted given the strong branch expansion and AUM growth.
Yeah, the branch expansion came in the later half of the year. That was one. Second, demonetization had to be factored in, boss. That was probably our prime concern last 1 year. So acquisition of new customers took a second fiddle. But I think, this year what we are looking at is the newer geographies, more client, newer acquisition, even in the impacted states as such,
Okay, and can you provide the update on your two tie-ups? One is Capital First and IndusInd Bank. How many branches we are offering these products? And secondly, what kind of book right now we have in 1 year time frame? How much we can build?
So IndusInd, I think, has picked on fairly quickly. I think, we've done our pilots, we've done our integrations, we've done quite a lot of them. I think, if I give you, in terms of other things, close to about, I think, 20 to 30 crores is what we are looking at month on month from this month onwards. That's what we are trying to do. At Capital First has been a little slower in terms of this thing. We've still been able to manage something in the two-wheeler loans across over there, but we are still integrating a lot of our learnings into that. And I think the uptake would be there from this year across in the two-wheeler loans, So that's how we stand right now.
So can we expect a meaningful book on that side this year, or this year also there will be the book building will be remain slow?
You can look at a very meaningful book this year.
Okay. And last question on the collection efficiency and the asset quality side. You said that the 98% number, you should look at the 99% of peers. But if I look at the credit cost versus our peers, obviously because of concentration, we have a higher credit cost. So when we will see the Satin also reaching a 99% collection efficiency in 2018-19, or it will be tough for us given the geography? Or second question on the net NPA side, you currently we have a net NPA of 2.6%. Why we have not taken an aggressive route and provided fully of a net NPA and then start the slate fresh for next year?
Well, it's a going concern. I don't want to shoot myself in the foot by not being in the going concern, So we'll take it as it comes.
Sure.
That's one. The second is, I leave it to you basically that from where we come from, if you still feel that we've not been able to really come up the curve in terms of our credit cost and in terms of our PAR wherever it was, and for us to reach 99, I think it's not too far away. If we could reach 98 in spite of the fact down by 50% in our PAR, I think 99 is not something which is not achievable, We'll be there.
Sure, sir. And last, one small data point. What is the interest reversal amount for the full year 2017-18? Interest reversal amount, sir?
So this was close to about 40 crores.
41 crore.
Yeah.
Okay, sir. Thank you so much.
Thank you.
Thank you. The next question is from the line of Rajesh Kothari from Alpha Accurate Advisors. Please go ahead.
Good afternoon, sir. Congratulations for a good set of numbers. I just have one question that, in the coming year again, since there are many state elections and farm loan waiver is going to be the norm, at least for next, 12 months. How do you see a situation like that, and, what risk management we have in place to make sure that, the incremental disbursement as well as, the collection, if such farm loan waiver happens, we don't get impacted?
I think, we have enough experience during demonetization of now 1.5, 2 years to counter all this now. I think, we've learned enough. We've burnt ourselves to a large extent. We've probably been in the most impacted territory. I think it's probably for us now, we just take into our stride. There's nothing, we can probably look at it, but I think, we've built up our system. We've built up our, the way Jugal explained you, the district-wide exposures and all that. I think we've taken enough measures for us to really look at these risk mitigating factors across, even if the elections come up, the farm loan waivers come up. They've been coming off and on, basically, but it's not, we've had an increase in our portfolio quality. We've had a much betterment across everywhere. So I don't think so. It's, now we have any cause for concern for at least us, after having been able to really look at it, So that has been there. The whole campaign with the administration, with the district awareness, we are having central leader workshops all across over there. We have held at least about 20 of them across India. So I think we have taken all the measures which probably can have to mitigate any possible risk emanating out of these farm loan waivers or the elections coming. They fully get up for that.
So say, for example, Karnataka, let's assume, they give the complete loan waiver or such measures, even probably in Madhya Pradesh, since the election is coming. Can you, give some color that, in terms of the steps when you say that, our systems are in place, what you do to ensure that there is no default of this book?
First, Karnataka, we are not present, so I can't tell you about anything about Karnataka, but where we were present, UP went through a farm loan waiver, and that was during demonetization, I think, we countered that. In fact, our collection efficiency went up after the farm loan waiver announcement. Punjab went through a farm loan waiver, we still went up. Rajasthan went through a farm loan waiver, we still went up. So I think the history probably has it to be written down. I can't probably outline now measures. I've given you a few measures which we've already done. I think, that's how our rapport with our borrowers, the way our guys are motivated to make people understand, our borrowers understand, the district administration to really get in rapport with them and do all that. And so we've taken all those measures across over there. And also the fact that we've been able to reduce our concentration across in every possible district as such, is countermeasures for all this,
Understood. And one more question in terms of your overall book. I don't know, sorry if I'm repeating this question. How do you see your loan book mix, over a period of 3 years?
Mix in terms of a non-microfinance product?
Yeah.
I think the base is too small of a non-microfinance product. I think, even today, our microfinance product constitutes about 98% of our book. My sense is next 5 years, I can give you a cue that it probably will be about 15 to 20% of our total AUM, the non-microfinance part.
I see. And that will, therefore, does it mean, in terms of your NIM, since as the non-microfinance book grows, your NIM will keep coming down to that extent? Of course, your, other ratios will keep improving in terms of your capital adequacy and the provision requirement, but I'm just saying how the impact it can have on your P&L.
Even if my NIM comes down, my OPEX is also going to come down. So for us, the margin will remain probably stable or maybe get a little better. So that's the reason why we set ROA of 2.3% plus this year, and we would like to maintain an uptrend in our ROA moving forward on year-to-year basis, even when the non-microfinance products start taking shape.
Okay, great. Thank you, sir. Wish you all the best.
Thank you.
Thank you. The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Thank you very much, sir, for the opportunity. Now, sir, if I see your this quarter performance, basically our cost income at 47% and ROA at 3.2%, right? With a improving trend of stable NIMs. Whereas for the whole of year, you are guiding for 2.3% next year. So where is the basically disconnect as compared to like in terms of stability of what we have achieved this quarter, which will not get repeated in next year, because of which we are guiding for a lower ROA?
So probably quarter performance is not an indication. We are still in the expansion mode. The portfolio has really grown up during the quarter, so that is where that number is slightly lower. But as of today, we feel that our OPEX is going to be in the range of some 6.45 to 6.5% range. And we want to balance the growth and the OPEX and the ROA number, etc. We have just come out of demonetization. So we will take some more time to have a stable, OPEX of less than 6%, etc. So where we are, probably a 1 quarter performance should not be taken as a base for next year.
Okay. So this quarter your OPEX to OEM was about 5.5%. So this is not basically a correct trend, right? That's what...
this is one quarter where we have done large amount of disbursement and the portfolio quality is also stable now. Mm-hmm. We are again in the expansion mode. We'll open new branches during the current year. Investing into other system processes, the result of which will yield over a period of time.
And we build it up quarter by quarter. So I think if you look at our past history also, I think, everybody probably, I think even in our peers, outperforms in the last quarter. And that's what we've been able to do. But on a stable system, that's why we've indicated 2.3% plus. We definitely would love to outperform it, and let's see, how things move out to be. But that's the minimum we think, we'll be able to achieve it.
Okay. Is the, like you mentioned that you have factored in 130 crores of credit cost as well when you are giving 2.3% plus ROA. So that comes to about 1.9% of credit cost. So is that also one of the reasons because of which...
one of the reasons, because we want to be very conservative in terms of our approach. And we want to, that's the reason why we factored in all this into our next year. And that's the reason why we have an ROA. So we try to outperform that also. Let's see.
Okay, understood. But on a steady state basis, the credit cost of 1% would be a fair assumption to make?
Yeah, that's why I repeated my earlier statement with someone, that, we'll be moving from 98 to 99 as my newer portfolio starts building up, because right now when I said we have a 99.7 on 33% of our clients, I think the moment it starts building up, and I think moving from a 98 to 99 will not be that difficult, But yes, 1% we would like to factor in terms of the credit culture, the farm loan waiver, the everything, It's always safe to have probably a slightly higher credit cost in your budgets here.
Understood. Sure. That's it from my side, and all the way best. Thank you.
Thank you. The next question is from the line of Sagar Shah from KSA Securities Limited. Please go ahead.
Hello.
Hello,
sir. Good afternoon.
Good afternoon.
Yeah, I had just one question. My question was regarding as a broader view, something like in the next 5 years, we'll be seeing something like the central government, whoever it comes the next year, but we'll see some allocation towards rural consumption or little higher, as we saw this financial year actually. Something like allocation towards rural for enhancing the purchasing power of rural people, for development of rural land in India. So, as a company of Satin Creditcare, and something like, how would you see an opportunity in the next 5 years?
I think you've asked a very good question. I think, probably what you're looking at right after demonetization, once the demonetization era faded out, I think, we've seen uptrend in our demand, we've seen good collection coming in. So I think, with a good monsoon also now being repeated, that's what the saying is. And what you said that yes, maybe a spike in rural consumption, the government probably looking at the rural landscape in a very different paradigm altogether. We have a huge opportunity, and that's why, we say that, probably for us, and that's why we've set a 40% growth. That's very easily achievable because of all these factors put together. I think what you said is probably absolutely right. There's a large opportunity which exists now with all these things happening in the rural landscape.
Exactly, because you as a microfinance, before demonetization, you even were pioneers actually. Or something like in giving money to people for betterment of them. And over the next 5 years, something like if we talk of rural power, if we talk of rural, something like whatever comes in the place of for their development, of SME business or maybe small scale businesses that will be developed over there.
Absolutely, you're right. So rural housing, a big thrust. We are already, into it. Consumer durables, consumer purchases, already a big thrust, because of all these, there's been an increase in credit from MFIs. There's been a large entrepreneurial focus in SME and all that, So I think all that put together, next 5 years definitely give us a very, very big impetus for taking in growth in a larger shape, And I agree with you completely.
Yeah. Thank you, sir. All the best.
Thank you.
Thank you. The next question is from the line of Himanshu Nisgani from Volcon Capital. Please go ahead.
Hi, sir. Congratulations on a great set of numbers. I wanted to get your views on the competitive landscape in terms of after the small finance banks cost of funding has started reducing. So probably from Utkarsh in UP and let's say Bandhan in West Bengal or in southern areas of Jeevan and Jana. So are you facing a change in the competitive landscape, or what's your
to be very frank and honest, there's nothing which has changed altogether. In fact, I think, for us, the market has, in fact, getting better in terms of our growth. In terms of the margin, etc., crossover, there's not been any change. I don't know whether I should be saying that or not, but even the cost of fund of the small finance bank and everybody coming up, well, they'll have to go through that. I think, that's probably one of the challenges which as those entities enter the retail deposit space or anything, that's a challenge which they'll have to face. So there's not much of a difference technically in terms of the margins or the landscape of the cost which is across over there. I think, fairly still. Doesn't make any difference.
Okay. And sir, another question being, what's the nature of tie-ups with Capital First and IndusInd Bank, in the sense the customer relationship stays with Satin and only the products are channeled through Satin branches, or once the loan cycle 1 is completed, then the customers then move on to with Capital First or let's say IndusInd. How does it work?
No, with IndusInd Bank, it's a very clear this thing. We do everything for the client as we do it in our own balance sheet. We acquire, we source the customer, we service the customer, we collect, we do everything which is across over there. And with IndusInd Bank, the best thing is that we get on-tap funding. We really don't have to plug there. Our requirement for capital goes down significantly across when we tie up with IndusInd Bank. So that's been a huge tie-up for us to really look at it. And now it's taking shape across over there. And let's see, I think, God willing, we are looking at close to about 20 to 30% of our book probably to be done with IndusInd Bank. But it stays in their books, but everything on the front end is done by us.
And with Capital First, sir?
Capital First is also the same thing, basically, but that's for non-microfinance product, So it's the same, we do exactly the same thing with them. It resides in their books, but we do everything in terms of the front end in these products.
Great. That's it from my side.
Yeah. Thank you.
Thank you. The next question is from the line of Ramesh Rajuri from Satin Capital. Please go ahead.
Morning, sir. Congratulations on an excellent set of numbers. I had two questions basically looking at the next 2 years. One is on inflation and interest rates. How does it affect you? Does inflation ticket sizes go up? What is your ticket size now? And interest rates, are you starting to see pressure on the borrowing side? So that's the first question. Second question is, since you're entering into newer areas on the eastern side like Bihar and West Bengal, we have had issues in the past regarding, ringleader, and especially in case of West Bengal, you have also an alternate model of lending, not necessarily the JLG model, if you take the example of Asa and all. So how do you see that competition playing out?
So on your first question, I think the pressure on our cost of funds, I think there's a slight pressure, but I don't think so. It's a pressure which probably can't be borne by us. I think, it doesn't affect us too much. I think at the moment, we are trying to convince our rating agencies to really have an upgrade for us. The moment that is there, I think, that pressure will also, whatever small extent to it is, will probably also die down. So that's not too much of a concern for us. In fact, that's not a concern which we are going through. And in terms of Bihar has been our state across for the last 7-8 years, so we have no problem. Bihar has stood out even during demonetization. And in terms of ringleaders and, I think, the other stuff which happens in West Bengal or anything or Asa, I think we follow the same methodology across over there. And I said as probably, maybe in my earlier statement that, UP has probably been the most toughest territory to work on, So I think, UP has been handled by us to the best possible extent. As I can say, I think, we'll be able to manage that. And these are cyclical things, so AP came in first at some point of time, then it was UP, Bengal, I think, you have to counter through your own process and your own system. And thankfully now with our technology being at the forefront and maybe the state of the art, cashless happening across over there, all these things like ringleaders, and all that stuff will probably have a backseat. They won't probably be making any inroads into our processes or something.
Excuse me, this is the operator. Ramesh, actually your voice is breaking up, sir.
Now it's clear?
Yeah, better, thank you.
Yeah. So sir, just continuing on the question of inflation, what is your average ticket size currently? Do you see it going up, and would you be rejigging your risk processes? Because then risks might also go up.
So our average ticket size in microfinance is about 30,000 rupees, and we have not budgeted any major, increase for the next year, we are going to maintain it broadly at the same level.
Okay, sir. Thank you.
Thank you. The next question is from the line of Alok Shah from Centrum Broking. Please go ahead.
Yeah, sir. I had a couple of questions. You can learn pretty good in entering into newer geographies, West Bengal or east of India. Is there a thought to kind of look at newer states now, or we kind of are contained with 18 states to operate in periods to come?
Alok, to be very frank, we have at the back of our mind to also enter the southern geography. When it comes through, I think, we'll probably be able to have a blueprint ready in the next 6 months to enter in all these newer southern states also, maybe or maybe a couple of them in the southern states, just as a matter of strategy to look through it. We'll cherry pick ourselves into when we reach and go into these territories. So for us, we have some blueprints ready. Let's see when we are able to really focus on and bring that on.
Sure. On the second point, because of a lot of cashless business done at the field level, how's the TAT moved? What's the kind of reduction in turnaround time that we've been able to get through?
Not to mention anything, but I think, we can probably disburse a loan in 3 minutes. That's it. That's what our TAT is now.
Wow.
So cashless probably has, that's what I said. You probably have the best, probably, or I won't say, I don't want to say it myself, but we have a state-of-art facility with us. TAT is 3 minutes, and even for us, live every minute, in fact, it's every 1.5 minutes, if you really ask me, exact this thing across over there. That's something which is very significant.
Right. Sir,
to a large extent, it'll bring scale to a very large extent,
Right. Okay. One thing that I was also looking here was from the fact that rating agencies in the past had their observations with respect to our capital adequacy and higher state concentration. The last 4 quarters, both of this have got addressed and addressed systematically. Is there some kind of dialogue with rating agencies as to, from the ratings point of view?
Hello, if you know someone and you can convince them, I've been trying to convince them for the last 1 year. I've not been able to do so. So I don't know. It's very hard for them to really, look at the whole journey as such. But it's been a journey where we've probably implemented every possible, thought process of theirs which could probably help us get an upgrade. We definitely are in touch with them. We're trying to make them also see how, in spite of the fact that we've hit demonetization in between, we've still been able to bring down our UP concentration. We've been able to raise capital multiple times during the last 1.5 years. I think, it's now for them to really look at it, from that angle, I can only advocate myself and tell them, and I think, that's probably what we've been able to do.
Sure. And when is that due? When is the rating due?
Well, after the results, I think we'll keep on pestering them till they don't give us an upgrade,
Right. The third question to you was on the kind of securitization. We generally see Q4 where the securitization goes up. Anything really to do with Q4 phenomenon, or do we want to keep securitization as certain percentage of our EUMs?
Well, keep a balance. Alok, there, as PC book starts increasing with investment, we will try to make that balance. But surely want to increase the ratio from the present level of the off-book portfolio. So slowly we'll increase that with a combination of BC book and the securitized book.
Right. And maybe last question before we go back to the main line. What's the kind of tier 1 that we would look ourselves to keep comfortable with? We are at 20% now. A number below which we would look to raise some kind of funds.
We don't want to give any guidance on that, but surely would like to maintain a, broad capital adequacy of around 20%. It is a thought process with a combination of tier 1, tier 2, with year one, should be at least around 17-18% or so. So that's not a guidance, but that is a thought process we are working with.
No, I get it. Sure. That's it from my end.
Thank you.
Thank you, sir. Yeah.
Thank you. The next question is from the line of Krishna Rai, an individual investor. Please go ahead.
Good afternoon, sir. On a very good set of numbers.
Thank you.
I will start by saying that I have been an investor in Satin for the last 2 years, and it had been a roller coaster journey. Less for me and then more for the company.
Yeah, it's been more for us, And thank you for being a part of that journey with us,
Sure. Just one quick question I have. I see that our PAR 1 and PAR 90 numbers have come down tremendously in the last 2 quarters, and even more basically in the last 1 quarter. But when I look at the collection efficiency in slide number 13, in Q4 of 2018, the collection efficiency is 98%. It was consistently more than 100% in the previous 2 quarters. So are we seeing any pressure recently, or it's just like, one of things?
So I think, if you look at it, when the easier buckets were being, I think they were being cracked, I think we've been able to do it, at that point of time. And that's why I said, for us now, the last of the strong buckets have remained now. And, we are trying our best, but I think, for the next couple of quarters, I think, this will probably still be a challenge which you're trying to address, because now what we left off is the last 130 crores unprovided, the last buckets which are remaining, the last difficult clients to manage across over there. I think, that's the reason why we'll move from a 98 to a 99, maybe in 6 months to 8 months, that's what we said, that's our next level to go up. But that will be done, definitely across when our new client acquisition rises to a large extent, the impacted clients where we are working in, or the cyclical clients, who are in the third, fourth, fifth cycle, they come in across when we stop, that bucket gets lesser and lesser. So I think it's a journey which moves across now from here to reach the pre-demonetization levels, And God willing, I think the way we put in processes, the technology is working on, the guys are motivated, opening up new territories, all that concentration coming down. I think it's not far away where we will probably be able to reach that 99 to 99.5% mark. And that's the reason why we have 99.7 in our new acquisitions as compared to the old cyclical clients where it is still 98%.
Sure, sir. Thank you so much, and I wish all the best. I know that we are on a great journey ahead.
Oh, thank you so much for being with us.
Thank you. Reminder to all the participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. The next question is from the line of Kushal Zaveri from Emkay Global. Please go ahead.
Yeah, thank you very much for another opportunity.
Excuse me, this is the operator. Mr. Zaveri, may we request you to speak closer to the phone, please?
Am I audible?
Yes, sir, you are. Thank you.
Yeah, just wanted to, point towards the slide number 48. The last line average ticket size on standalone basis, shows about 30,000 rupees for MFI lending. Now we have a gross book of about 5,000 crores with loan accounts of about 2.4 million. So how do you, sort of reconcile the math? 5,000 crores divided by 2.4 million would be about 20,500, whereas the ticket size shown in the presentation is 30,000.
Oh, sorry, I don't get that. Which slide you are referring to?
48.
Slide 48, yes.
Maybe 47 actually, not 48.
Yeah, 47. Yeah. So what are you saying?
Operational retail standalone.
Yeah.
Yeah, productivity metrics for MFI lending.
Right.
We have a gross AUM of 5,000 crores.
Right.
And number of loan accounts is 2.4 million.
Right.
That comes to about 20,000 or 20,500 rupees per account.
Right.
If I look at the last line, average ticket size is 30,000.
So that is the average of disbursement, while here you are trying to calculate the outstanding balance outstanding.
Okay. So these are, so after whatever repayment, this is the 21,000, but at the beginning of the cycle, it would be 30,000.
Yes.
Okay. And second question is on your NPL side again. Out of, there has been some discussion which happened earlier also. But this, whatever is left, 130, would you be able to put, some probability as to how much of this is recoverable? And question number 2 is that, during the quarter, if you can help us understand what were the additions, recoveries, and how much did you write off?
So we don't want to do a guesswork on the balance 130 crore left out. We are trying our best to, work around that. But as Mr. Singh said earlier, that we have taken, whatever is our best estimate in our next year's budget and guidance. So we don't want to do a guesswork on the, potential losses out of the current.
But we factored in all the 130 crores. We've already factored in, and that's why the ROA now comes at about 2.3%.
Okay.
Or whatever we achieve in this, probably will increase my ROA to whatever extent it goes up. And we are trying our best, again to get this back. So we're putting all the efforts. The teams are motivated. We're still working on it on the ground. We're trying everything possible to get these clients back and the overdue back into the system.
And fourth quarter, movement of NPLs, if you can help us, what were the additions, and how much was recovery and write-off separately?
I can give you the annual numbers. So we have made additional provision of roughly 35 crores on a net-to-net basis. So last year we had 60 crore of provision in the balance sheet, which is now close to about 95 crore. And we have written off roughly 180 crore during the year.
So what I'm asking is that, movement in the gross NPL numbers, it was 522 crores at the beginning of the year and 25 crores at the end of the year.
Right.
So how much was new addition and then how much was recovery and write-off?
We do not have that number handy right now, but
okay.
We can...
Sure. Thank you very much. That's it from my side.
Thank you. Reminder to all the participants, if you wish to ask a question, you may press star and 1. As there are no further questions from the participants, I now hand the conference over to Alok Shah from Centrum Broking for closing comments. Over to you, Mr. Shah.
Thank you, sir, for this detailed insights and taking us through the journey of FY18. We wish you all the very best for FY19. Thank you all for joining us on the call. You may now disconnect and have a